Everyone, I want to do a quick video to show you a cool type of trade called the put credit spread. So if you haven't watched my channel, you know I love to talk about options. I love to talk about stocks. So let's get started talking about Microsoft. So currently Microsoft is trading at $410 a share. Morningstar, which is a service that provides analyst reports and valuations for different stocks, they currently have a fair value of $490 on Microsoft with a medium uncertainty rating and a wide moat. So medium uncertainty meaning they are somewhat uncertain about it, but not super uncertain. So there are 4 different uncertainty ratings. If you have Robinhood Gold, by the way, you can get access to these Morningstar reports. So there's low, medium, high, very high uncertainty. This is a medium, which I think if you look at the documentation that Morningstar puts out, that means they have about, the valuation range is about 30% up or down, meaning the true value is a range, because we know value is a range, not a particular number. It's in a range of 490 plus or minus 30%. So you do the math. That's your range. Finbox is another service I like. It's a paid service. They will use a bunch of quantitative models and analyst projections to come up with a fair value. Their fair value on Microsoft is $420, so roughly fairly valued according to Finbox. So at least it's not overvalued, right? So this might be a good candidate for what I look for in put credit spread trades. I like to do these on indexes or very stable, generally very large cap companies that are not going to, fluctuate wildly. So what we're going to do for a put credit spread, which I also like to call insurance reinsurance trade, and I'll explain that in just a second. So we're going to sell the March 7th 390 put. When we sell a put, we are insuring Mr. Market on 100 shares. So we're saying, hey, we will, no matter what happens in the market, we will buy your shares for $390 per share. We're simultaneously going to buy insurance. We're going to buy a put at 385 from the market. And we're going to say, okay, if it goes below 385, we have insurance. We can always sell back our shares to the market at 385, no matter what happens. So we're selling insurance, but we're protecting ourselves by buying insurance. The spread between this is what we collect. It's our net credit. So we collect some premium for the 390. We will collect more for the 390 put than we have to pay for the 385 put because 390 is closer to the current price of 410, closer to at the money. This is the at the money price. This is out of the money because it is below the price and it's a put. So we collect $86 as our net credit, and our max loss is going to be $414. I won't get into the details of the math there. It has to do with the spread width, how much we collect, and what our total possible loss is minus the credit. So $414 is as much as we can lose. If the stock goes to zero, we only lose $414. If the stock goes down $50, we only lose $414. But if the stock lands between these two strikes, we'll lose less than the max loss. It's only if it's below 385 that we get the max loss. So the days in the trade before expiration is 26 days, so a little less than a month. The return on risk. So we're risking for 414. We're making $86. So $86 is about 20.8% of 414. So we're making about a 20% return on the risk capital, right? The annual rate of return, if you were to do this every 26 days, you would get a 292% return over a year. Now, what I will tell you that most YouTubers will not tell you is that you will not be able to do this every single month, no matter what anybody tells you. So you're really not going to be able to get this 292 annual return by doing this every 26 days, okay? Sometimes you're going to lose on these, and you're going to hit that max loss or somewhere near the max loss, okay? And that's going to totally wipe out your $86 net credit and then some, right? So factoring that in, you'll win most of the time, generally, odds are. but a lot of the time, or not a lot of the time, some of the time, you will lose. So you got to account for that. So generally, what I've seen in my own portfolio is doing these put credit spreads at the 20 delta, which is what this 390 put. That's how I came with the 390 put. Combination of 20 delta plus I look at the chart. So I drew a rudimentary chart here of the price action since July. They hit a low of about 385 back in July. I think there's good support there. So hopefully we wouldn't go below that. But right now we're sitting at that 410 level here. And I would expect a bounce because every time we've come down to this area, 410 but to 415, we have bounced back up to the 440, 450 range. Okay, that's my thesis. So I would expect the same thing. Now, this puts our break even if we did this trade. As long as the stock is above 389.14, we won't lose anything. Okay, so $389.14 is our break even point, which is about a 5% drop from the current price of 410. So we have about a 5% buffer in the price as long as the stock doesn't go down more than 5% over 26 days. We should pocket this 86 bucks, and then we can do it again if the conditions look right. I hope you enjoyed this video. If you did, please like and subscribe to encourage me, incentivize me to make more of these videos. I've got my new whiteboard here, so maybe that will help. If you liked it, please let me know. If you have any questions, comments, please leave them in the comments section, and I will see you in the next one.